All right, guys, welcome back to the Educated Home Buyer, where our goal here is to help you buy right, borrow smart, and build wealth through real estate ownership and financing. For those of you who are new to this, my name is Jeb Smith, and I'll be your moderator this evening. Appreciate you being here. Josh Lewis, resident mortgage professional, is here with us as well to answer any mortgage-related questions. Josh, welcome to the show.
I prefer pilot co-pilot, Jeb, is the way I
Pilot,
like to
co-pilot.
go with it versus moderator, host, grand
pilot.
poobah, however you want to call
Grand
it.
Poobah. Oh man, that was a great song back in the day.
Yeah.
The Grand Poobah. Anyhow, we were out last week. I had a little spring break vacation, much needed, but I'm glad to be back, seeing a lot of regular viewers already in the chat. I appreciate you guys being here. So we're going to start like we always do, just update a little bit on the housing market. So the title of the video is "The Market is Slowing." The housing market is slowing. And it is, but that doesn't mean crashing. And that's what we're going to talk about a little bit more tonight. So I have personally seen inventory levels rise here locally each week. I update you guys. So here in Orange County today, sitting around 1,797 properties. So that's about 20% increase from where we were 2 weeks ago when we were at like 1,480 or so. Huntington Beach, 116, 117 as we came on the show. Last time we were here at like 83. So that's a bigger increase, 30-40% in the number of active listings. Now, what I mean by slowing, Josh, I know you're seeing this and hearing this and reading this as well, is properties are still selling, right? I put a property on the market. I did a video about it. It just took a little bit more time to get offers. I thought I'd have an offer the day of. No, it happened 2 days later, right? There was very little activity with regards to offers, even though we had showings that weekend. But on Monday, I received 6. So I went from what I expected, probably 10, 12 offers is what I was thinking, or what would have happened a couple months back. I still had 6 offers, all above the asking price, or one was below, but ended up coming up above. But that just shows you things are changing a little bit, right? And we've talked, Josh, this couldn't continue forever, but it also doesn't mean a crash.
Absolutely not. An example that you and I talked about over in my neighborhood, a spectacularly beautiful, fully remodeled home comes on the market. They ask 2.4 million. I don't know. Maybe Jeb, I don't think there's been a sale in the neighborhood over 2.1. There's 300,000 high. And you go back to December where rates were and sort of where the mindset was. It probably wasn't the most atrocious price, but they just closed at 250. Still the highest sale in the neighborhood. Took longer than anyone would have thought by seeing a beautiful home, but they were aggressively priced. Exactly. And they got a good number. It was aggressively priced. They ended up getting a good and a fair number, 150,000 higher than any sale ever in the neighborhood, for far and away the nicest house that's ever sold in the neighborhood. So anecdotally, those are the types of things that we're seeing. Like Jeb, you probably saw the number this week, headline everywhere. This is fun when any outlet, analyst, media source, news source comes out with data. Redfin said, hey, 12% of homes listed or sold last month had a price cut. And you go, oh my God, 12% had a price cut. Well, last year, when the world was on fire, 9% had a price cut. So is 12 more than 9? Yeah, it's a good, 30% more than 9%. So it does tell you it's slowing. But anyone that looks at this and says, oh my God, we're headed for a crash. And it's funny, you guys are watching us here on YouTube. YouTube is hell. Like there's no world in which anyone takes a nuanced approach to what reality is in the middle. It's put the craziest title and then the craziest video. Either way, either people telling you, hey, this market's going to keep going and totally bulletproof and nothing there. Or, Jeb, you and I talked this morning, a lunatic agent here in California that actually has a decent sized following. No data whatsoever. Just went through and said, but basically no data whatsoever. Just went through and said, trust me, this is going to be terrible. There's going to be 10 million foreclosures. That's a very specific number for someone who has no data backing that up. So just a long way of saying, we talked back in the fall, what does it look like when the market slows, and why are we nowhere near a crash? First of all, we've only ever had one crash ever in the history of United States real estate. And there were very specific reasons that we don't need to go back into. We've gone through them 150 times. But we have had corrections in different markets. We've had 3 or 4 here through the years in California, in addition to the big crash. Markets like Texas, where they have boom bust economies, they've also had housing crashes or housing corrections. And so you look at that, and it can happen. But what does it look like when we're still sub 2 months of supply? We're only a third of the way to a neutral market where it's balanced, where we have an equal amount of sellers and buyers, and prices are kind of stable and not having this massive upwards pressures. And to put it in context, back in 2007, 2008, we were over 24 months of supply. That's what a crash looks like. So in terms of when you're watching other people's information, I don't think you should just tune into Jeb's videos or watch he and I here on the live every week and go, oh, those guys have the answer. I want you to look at other people's information and analyze it, but look at it in the frame of, are they dealing with data? And then dig into the data. That's the cool thing about Google and the internet. You can see, are they tweaking the numbers? Are they twisting them? Are they lying with them? But some important things we have to look at. We have to get back to 6 months supply before it's neutral and equally balanced between buyers and sellers having power. Before we get to a strong buyer's market, it's 12 months, and crash level is at about 24 months. One of the other pieces of data that we talked about, when we had that crash, we had about 70% of the homes available for sale were bank-owned properties.
Right.
So until you see that, you're nowhere near it. And again, speaking of crazy garbage that you find on YouTube, people making videos saying foreclosures are spiking. You're like, where do you get the data? Like, the numbers just came out over the last month. Homes 30 days or more delinquent went down 0.1%. Homes seriously delinquent, 90 days or more delinquent, which is where you have to get before you have a foreclosure, also down 0.1%. So
I saw something similar, Josh. I mean, in fact, what I saw was, the headline was, in January was like foreclosures increased by 25% or 700% or whatever the number is. Yes, because there were none prior to, but even then I saw since then the numbers have actually gone down. So it's not, foreclosures are not a feasible option if you are a home buyer. Just keep that in mind. They are out there, but they are going to be at market value, and there's not a lot of them rather.
And put it in context, Jeb, a big correction is 10 to 20%. So if you have a 10 to 20% correction, think of where people that bought last year are sitting on anywhere from 10 to 20% appreciation from where they bought. So who is at risk? The only people at risk are the people that have bought in the last 6 months or so, and that would be if prices dropped today. They're not. We're talking about a decelerating market, a market that's moderating, slowing, not in any way crashing. We're still seeing nice homes with multiple offers and going above list price. Now, it's way better. I mean, we go back, we talk about Lupe all the time. Last January, February, almost every home they made an offer on had 20 plus offers. Now, most of our clients are in situations where there's 4 or 5 offers, and you're actually able to talk to the listing agent when you call. They want to talk, they want to hear from everyone, because there's not so many that they're inundated. So there's absolutely a balancing market, and we got to look and say, where does it go from here? The other one, Jeb, we can just kind of transition into interest rates. The crazy shit you see on YouTube, people saying rates are going to 9, 10%. Like, really? Why? What world causes that? One of the videos that popped up, one of my workers here says, hey, this guy, he seems to have a pretty good point here, because the Fed owns all these mortgage bonds and they're going to start selling them. So he says interest rates are going to go to 9%, and they want to crash the housing market because these inflation numbers are so crazy. Say, well, whether you like CPI or PCE, the way they weight both rents and home costs, it skews to the low side. So it vastly understates housing's impact on inflation. So crashing housing doesn't fix your headline inflation numbers. So first of all, it would be crazy. Housing and construction is over 25% of the economy. So they're doing everything they can to avoid a recession. And this person saying, no, they're going to crash housing because it'll make inflation numbers better. And they have the tool to do it, because if they just rapidly sell off all their mortgage bonds, now mortgage rates go up and they can keep their borrowing costs with treasuries fairly low. All of those things are semi-plausible if you just take them in isolation. But the reality is they've already come out and said what their plan is. Jeb, was it 35 or 40 billion a week of mortgage
35.
bonds they want to sell? So it's 35. So it's roughly about $1 trillion. Now, don't get me wrong. I'm not saying $1 trillion is not a lot, but over the course of a year, they would sell $1 trillion worth of mortgage-backed securities. And you go, okay, you guys talk to us all the time about supply and demand. We bring $1 trillion of supply to the market. Where's the demand coming for that? Well, let's look back last year. There were $1 trillion, almost the exact inverse of what they're coming to market. There was $1 trillion more of new supply of mortgages to be sold into the secondary markets based off of all the refinance and purchase activity that was going on. So the market only has to absorb the same number of mortgage-backed securities that they did last year. And again, looking at, is the Fed going to aggressively dump this portfolio when most of it is at like 2.5% and 3% coupons, and we're currently at 4.5% and 5% coupons? You have to sell that at a significant discount. It's not like, hey, I've got $1 trillion worth of bonds, I'm going to sell them and get $1 trillion back. You have to discount it significantly. So it is in their best interest to do it in a controlled, moderate, slow way. So long way of saying, we don't have the answers. Jeb and I this morning, probably 90 minutes of just going back and forth on news articles, and really smart people with really different opinions on what comes next. B of A's lead bond analyst comes out today saying, we've seen the peak of inflation, and treasuries by the end of the year are going to moderate back to 2.25, and we're at 2.84, 2.85 into today. I look at that and I go, that's aggressively positive. But then you have other people that are saying, we're going to have 10-year treasuries at 4.5%, 5%, which we haven't seen in 15 years. So look at the data, analyze it, and just see what the person's angle is. People accuse Jeb and I here, well, they're permabulls. They make money by selling real estate and selling mortgages. Well, we both have done this for more than 20 years, and in good and bad markets, we fed our family. I don't have any incentive to give people bad advice where they don't want to come back or send their friends and family over the coming years. So long way of saying, just look at the information you're taking in. We're in a new and different market than where we were. And everyone should be thinking harder about their decisions than they were this time last year.
There you go. And if I looked uninterested while Josh was talking, it's just the fact that I'm absolutely tired of talking about housing market crashes and all the other garbage that goes along with it. So it's not my interest in what Josh is saying. It's just that we rehash this stuff and talk about it so much. But with that said, let's talk about a scenario here. So you're a home buyer out there. You're having difficult time finding property, all of that. What I can tell you is that there's more inventory coming. So you're going to have more options. Now, that doesn't mean it's going to necessarily be easier for you, because 2-3 offers on a house still makes a multiple offer situation. But some of the things that we've talked about in other videos and on here about how to present your best offer, things you can do to help your offer stand out. And now is the time to start doing those and combining those and helping to to get your offer to stand out. Like I mentioned a moment ago, I had 6 offers on a property, and it took a day or two longer to get offers than I thought. Now, granted, it still sold in 3 days, which is very, very quick. But here's the kicker. The seller called me on Sunday. In fact, was I out of the country at that time? I think I was out of the country. And they texted me and said that they were disappointed. I wasn't out of the country, but nevertheless, they texted me and basically said they were disappointed they didn't have any offers. And I thought, wow, like we've been on the market for 36 hours and they're disappointed. But the reality is people are so used to things selling so quickly, which isn't real. I mean, it is real because it's happened, but it's not normal for things to move that fast. And so the seller, because they had already bought another house in another market and dealt with a competitive environment, they thought that's exactly what they were going to get. And when they didn't get it, they started getting concerned. So if you're a buyer out there at the moment and you're seeing properties that may be sitting a little bit longer, this might be an opportunity for you to get not necessarily a good deal by getting much lower but being able to get something at the price or maybe a little bit lower, because that seller might be just looking for an offer. Now, I'm not telling you that's going to happen, but what I can tell you is the seller, if they had only received one offer on that property, and it was somewhere near, they probably would have accepted it just because they started getting concerned, even though me being the professional tried to help calm them down and guide them, and they understood, and it all ended up working out. It ended up selling for 5% over the asking price, but it didn't happen immediately. So that happened. That took a couple of days longer. But what about the ones that sit maybe a week on the market and don't get offers? Those are the ones for buyers. If you're a real buyer, again, you have that longer term time horizon, money in the bank, not stretching yourself, all that good stuff. Those are the ones that maybe you shoot for in a market like this. Thoughts on something like that, Josh?
Same thing here. It's like we're talking about the same stuff. It's the market is absolutely slowing, but absolutely still in favor of the sellers. And anytime you have a change, people aren't used to change. We had 2 solid years where a seller could do anything they want, and buyers had to bend over backwards and do gymnastics. And you're talking about a situation. How many offers did you have, Jeb?
On the last one, 6.
Okay, so 6 offers and it went 5% over list price, and that's alarming to sellers. It's a change, and if we get down to, 1 offer in 30 days and you sell for 5% under list price, it might be something to be alarmed about. But
that's a crash.
only if you're making YouTube videos.
No, in all reality. So if you're out there looking, just keep doing your thing, keep sticking to your plan. Talk to your mortgage professional when you're making offers. Make sure rates are where you think they should be, right? Rates are moving every day. Even with the 10-year getting better, rates aren't seeming to improve. And when I say better, it's not, a huge jump, but it did improve today, and no real impact on rates. So you need some stability in the market. You need the Fed to do what they say they're going to do and be aggressive about it, at least for a couple of months. And I think you'll see some pullback, or at least some normalization in the market. So
yeah, you said something important there, Jeb, that they need to follow through on it. So the market is expecting in the next 3 Fed meetings, if you look at the futures markets, they're projecting 1.4 points
1.4.
of tightening. So that's a half, and they don't do 0.4.
Yeah,
so
I was wondering, how do you get to 0.4? But yeah,
it's just the average. It's just where the market is settling out in terms of their bets. But they're really projecting 3 half-point increases at the next 3 meetings, and we need that because that is still not neutral in terms of fighting inflation. I don't see a way that the Fed does what they need to do in terms of fighting inflation without pushing us into recession that's going to bring these things back in and normalize them. So it's going to be rough. It's going to be rough for the economy and for everyone. And as much as people didn't like the last 2 years, it was pretty predictable. You just saw, the weather was just like yesterday. It was hot and uncomfortable, just like it was yesterday for 2 straight years. Now we're going to see things shaking out and different and changing, and change is uncomfortable for people, and we're going to expect that. But I do expect rates to moderate. I don't know, if someone wants to pin me down and say what happens, I think rates continue to go a little bit higher from here. Is that 0.25%? Is it 0.75%? I don't know. But I do expect that by the end of the year, we'll have seen the worst of it, and they will begin moderating back down to a significantly lower level, not down to 5% if they peak at 6, but somewhere down, in the 4% range, because that just in the bigger picture of things in terms of long-term GDP growth, and what inflation looked like prior to COVID, prior to the Ukraine situation, that's probably where we're going to settle in. But is it going to settle in there in 12 months and everything's calm and normal? We got too much.
Depends on who you ask. Bank of America analyst seems to think so.
Seems to think so. But what we talk about, there's just too many moving parts. There's too many things to analyze. I would expect we're going to have a year or two of a lot of movement and discomfort for those of us who are trying to project and make decisions. Even you at home saying, do I buy? Do I sell? Do I rent? What do I do?
No, understood. So, Logical Thinker has a question, Josh, that you and I talked about this morning. Did you ever read the Dallas Fed report?
I only got the bullet points on it. I didn't get super deep into it.
So he's asking thoughts. So my thoughts are, I read it. Obviously, there's some good points in there about stuff, but what I want to be clear on is they aren't saying there is a housing bubble. They're saying that there's a higher chance of there being a bubble. And granted, there's some points in there that they make that are very clear to support that. but they're not even certain in what they're saying. Which, again, it's a headline that somebody took and ran with an article on it without actually digging in to the key details of their report. So I'm not concerned about a bubble because, I this is when you have supply low and demand high, people are buying, right? And it's not one offer, it's not two offers, it's multiple people bidding. There's a lot of cash, there's a lot of down payments, there's a lot of things pushing prices up. With really good credit out there, right? And a lot of equity in property versus last time, no equity in property, liar loans, the disparity between what it costs to rent and what it cost to own a property the gap was huge. So when property values did decline, people couldn't qualify. It was a really simple, equation for that seller to say, you know what, I'm done with this property and go rent something a lot cheaper. Josh just told the story of the foreclosure he bought where he went in, the guy was there and basically talked to the guy and was like, hey, listen, you can rent the house across the street for significantly less than you can to try to keep this thing that you owe way more on. That's the case. But right now, listen, most markets out there, there's very little difference. California is obviously abnormal in this, so you can't use California as an example. But many states out there, the difference in renting versus owning, it makes sense to still buy property in many of these markets. So, Josh, anything you want to touch on specifically out of the Fed?
One of the things that they hinted at is the same thing that I sent you the other article, and they're drawing different conclusions with the same data. So they like to use the multiple of rents to prices and sort of discounting future cash flows off of that. And the thought process there is that if home prices get too high relative to rents, it's easy for people to decide to rent, and that decreases demand for housing and decreases prices. So the Fed's numbers, the Dallas Fed's numbers kind of show that we're getting towards the high end of that. Now, the other article was a gentleman who you guys all see these headlines where an expert who called the last market top is seeing same signs. Well, he actually went through it and he said the biggest signal that he relies on is that price to rent ratio. And he's saying rents are so elevated in most areas that you're not seeing that big difference. So even not walking away from my house and renting the house across the street, but selling my house and renting the house across the street isn't going to save you much money. Like, Jeb, how many times have you had a conversation like this with either a viewer shooting you an email or someone calling, hey, we're thinking about selling and just cashing in and renting, and then you show them what rentals in the areas that they would be willing to live in, and they choke and they go, yeah, I'm not going to do that.
I had a client, a mutual client of ours who bought a couple years ago, and he basically has a property it's a condo, there's stairs to it. He calls me and says, hey, look, I'm thinking about selling the property. I said, okay, let's talk about that. What does that look like? Have you been pre-approved? No. Okay, get pre-approved. Okay, gets pre-approved or has a conversation. How much can you afford to purchase? Granted, he's going to be able to sell his property for about $450. Okay, he's pre-approved for about $450 to $500. So it's a lateral move with regards to price. And quite frankly, there's nothing out there in that price that is downstairs level that doesn't have stairs. So first off, he's not going to be able to find that. Secondly, he goes, well, maybe I'll just go rent something. Okay, what is your mortgage payment now? We talk about it. Okay, let's go see what rentals are for something like you're looking at. It was more money. And so it just didn't. He's got to do something because the stairs are obviously getting in the way, but I don't know what that solution is. There's not an easy, it's not like, hey, this is an easy decision. I'm just going to do this and make my next move. Now, it could have been that easy because he called me and wanted to sell. And I said, no, let's talk about all of these things before we put your house on the market. Because if I do, it's going to sell immediately. If you don't have a plan, you're going to be in a tough position. We walked through the plan and now it's like, okay, selling is on, in the back seat for now until he figures out the other steps. So it's not as easy as just putting your house on the market and finding something comparable to rent.
In the context of this conversation, what are we saying? There's not a huge discount there. You have to put a roof over your head one way or the other. So it's tough. I can tell you, versus this time last year, I don't ever want to say that most of the people that we talk to qualify, but they do. A large majority of the people that inquire qualify, because they wouldn't be thinking about buying a home if they didn't have pretty solid income, decent credit, and a little bit of money put aside. We're talking to more and more people, and it's not that they don't qualify, but they qualify for last year's prices. So we've talked many, many times on the show about willing demand. Hey, I want to buy that house, versus able demand. Hey, I can qualify for the mortgage. And we're ending up with less able demand in the current market. And the funny thing is, everyone needs to be very careful of what they asked for, because this time last year, we had a lot of comments here saying, hey, I just need rates to go up to put a break on these prices. Now, we got a big run up last year, and now we're seeing the break on the prices. And I don't think, if we were to sit here and bet, it's going to be hard from here forward 12 months to next April, do we see double digit home price appreciation? So, and we've been asking for that and wanting it to not happen. So now to panic because we're getting what we all asked for and wanted is a little bit crazy.
Agreed. So in the meantime, we've got a couple super chats, some super stickers here. Rob Mace, $5. Thank you for that, Rob. And then we've got Jay up here giving us 99 cents and $1.99, baby. Thank you. He's poor, he says, but we appreciate
the dollars for me. The 99 cents is for you.
That's fair. I'll take it. So let's get into some questions here. I mean, again, the last thing I'll leave you with before we get into this is we're in a cautionary market. Okay. I think Josh and I are both on the same page here. And people will say, Jeb, you've said home prices were going to go up forever. No, I've never said that. I said, I'll be clear. I said last year towards the end of the year, I think home prices will be higher next year this time. I still believe that to be true. But what I'm saying here now is cautionary in the sense that we're starting to, again, we didn't expect home prices to increase by 10% in the first quarter. They have. Things need to calm down a little bit. So if you're buying, just have that longer term time horizon and you're going to be in good shape. But with that, let's jump into some questions here. We got a lot of people reaching out and telling us where they're from. Appreciate you guys. Let's see, Josh, do you see? I saw one right to start with that was a good question, and now I lost it.
The fun part, Jeb, I wanted to point something out to you. This will mean nothing to you guys watching at home, but the system we use to stream here is called StreamYard. Did you notice that if you hover over a comment, there's a little star over there now, and if you star them, it goes into this starred group, so we will never have to worry about losing a good question
Where's
again.
the starred group? I don't see a starred group.
So you see where it says
live?
I
do see starred group. Look at that. They're
so
getting creative.
when you see one, you just mark it with a little star, and we don't have to worry about losing it.
That is good stuff. So here we go. I'm just gonna go in the starred here. You just click some stuff and what?
I'll find questions and you go and start and answer them.
Well, let's go here. Let's see. So starred, we've got you starred Jose. Jose was at Disneyland yesterday. After we went to eat at Tocos Los Cholos.
Tocos. When did you eat Tocos for dinner, bro?
Tacos
on hey, 420. This guy's over here talking about Tocos.
Tacos Los Cholos. Wowzers, you guys need to try. So hey, we'll try Tocos Las Choles. Tacos.
All you ever have to say is wings or tacos, and the answer is yes.
Yes, all the time. The answer is yes. Let's see here. Melissa just went into contract Riverside. First time home buyers putting down 5%. There were multiple offers. We were about to be priced out. Thought it wouldn't happen for us. So congrats to you, Melissa, on getting an offer accepted. Stick to your plan, right? That's what we talk about all the time. Don't get FOMO. Just stick to what you're planning on doing, and things work out the way they should. I'm a big believer that things will work out the way they should. So congrats to you. Nikki says, what are the top builders seeing? So I don't know. I think that's going to depend on the area that you're in. I have a buddy that took a job in Florida recently to build construction, new developments down in Florida in the Orlando area, and they're booming. Property still selling hand over fist, waiting list, the whole thing. So in markets like that, still moving forward. Here in California, most new construction is selling relatively quickly. I don't track new construction quite that closely, just because there's not really a lot right around me directly. I don't really have a lot of clients looking at new construction per se. But one thing I do want to point out is, the latest numbers came out for housing starts being up and permits being pulled or up and all of this stuff. Let's be clear here. If we go into a recession, the very first people that are going to stop doing what they're doing in many is builders, unless they already have properties in that they're already working on. Builders don't typically go out and start looking for land and trying to take big loans and do all of that in a recessionary market. So if you do see a recession, in my opinion, you're likely to see construction halt to some extent, not halt entirely, but slow, which only puts more pressure on building, which puts more pressure on supply. And depending on who you read, what you read, who you believe, 3 to 6 million homes short. So I don't know. Thoughts on that, Josh?
Builder. So this is funny. We talk about trying to read the news. I was trying to find it, but I saw a headline this morning. I didn't read the article. It says, despite higher rates, builders still optimistic. And then now here on Bloomberg, it says home builder sentiment in U.S. drops to lowest level in 7 months. I don't have the context for the number, but I would bet it's very similar to Redfin saying price cuts were 12 at a high of 12% versus 9%. The figure's at 77. I think that's still, they're fairly optimistic. But think about this for home builders. Here's what they're dealing with. They have limited inventory. They've tried to boost production, but they've been hindered by supply chain challenges. So getting the materials they need. So the costs are going through. So getting the materials is hard. When you get them, the costs have gone through the roof, and they're having a hard time getting labor to put the stuff together. And then they have higher interest rates for the buyers. There's less of them qualified. So despite that, they're still fairly optimistic. So long story short, I don't think builders are all that different than the rest of us. They're looking at it going, it's a good market, but it's not nearly as good as it was. And there's definitely some things to keep an eye on.
No, good stuff. I was looking for another question that I didn't see you had put in there, but I'm trying to look for it because it was a good one and I forget who it was directed to exactly, but I don't see it anyhow. So I'll just go back in here and start.
Well, hey, we got a simple one. David Pooh says, how does buying a car affect mortgage eligibility? If you qualify for a $900,000 loan and I buy a $50,000 car, is there quick math to calculate how much you'll qualify for now? No, there's not any quick math because it's different for different people. If 900 is your max and you buy a $50,000 car or finance $50,000 worth of car, that can easily be a $1,000 monthly payment and make, at current rates, it's a big difference. You're probably talking $150,000 difference in your qualifications. So it depends on what that payment looks like. If you are absolutely maxed on your qualifications, and you could be maxed on a front end debt to income ratio, meaning the housing payment to income, but not have any other debt and easily absorb that. Or you might have a high back end ratio and that pushes you over the top. So there's not a simple or easy way to do it. We have several of our astute viewers here said, bro, wait till after you close on your house and then buy the car. And that's probably the right answer.
There you go. Good stuff. I'm still going down here, Josh. There was a shout out to you in those comments there. If you want to take on that. Here, actually, this is the question I was trying to find earlier. It's from actually the same person. So Alex came on earlier, said, hey, y'all, just wanted to stop in for a sec and give you dudes a shout out. Awesome info and news regarding real estate. 2 weeks ago, you said to reach out regarding a lender, Josh. I am working with, I guess, okay, so that went on to something else. So I thought you had referred him a lender, but you did not. I see now how the two go together. But
he didn't need our help. He got
he's working with Matt. But nevertheless, tonight, if you do need a referral, you can reach out. I'll put a link up there in just a minute. But he says, actually, I do have a question. Say you lock in your rate at 15% down. During the process, house appraises for higher than the purchase price. Now you have 20% equity. So you gained 5% during that process. What happens? Do you get to avoid mortgage insurance or anything like that, Josh?
Absolutely not. So for the purposes of the loan, your loan to value is based off of the lesser of the purchase price or the appraised value. So if we see this the opposite way, you agree to pay 800,000 for the house, it appraises for 750. The loan is based off the 750 and you have to cover the gap. Now on the other direction, it doesn't go in your favor. You agree to pay 800 and it goes and appraises for 850. We're going to go off the lesser of, and you don't have to bring in any additional money, but your loan to value is calculated off that purchase price of 800. And for a future loan, it's not like you can close that and refinance 2 days later and get rid of your mortgage insurance. You cannot use the appraised value to qualify for the loan until 6 months after closing on that. So you'll get to benefit at some point, but you can't benefit at closing.
Good stuff. So Sammy, would you recommend cash buyers to wait until interest rates increase a bit more? So I don't think so. I think if the right property presents itself, you buy it now. Why wait? Because I do think even if homes sit a little bit longer, if they have a professional agent, an agent that understands and knows the market, they're not going to let their seller just reduce the price, right? In the case that I mentioned a moment ago, I wouldn't have let my seller just reduce the price immediately. That would have been crazy. It would have been as if I didn't know what I was doing when I helped them price that property. And if you guys watched the video when I talked about this property, I was the highest price in the 3 listing presentations that the highest in the interview process, right? So they interviewed 3 agents. There was one agent said they thought it was worth 850, another one at 875. I said I thought 900,000. And even at 900, I thought it could go higher, but I thought that was a fair number, a reasonable number for that property in that market. It sold at 950. So even though I was the highest, it still sold for more, but could I have got them to go down in price? Probably. But as a professional that understands, knows how to read comps, that sort of thing, they stuck in their place. So you get the seller that has an agent, maybe a new agent, their cousin, somebody that doesn't understand the market, panics because they don't get the activity immediately. Those are advantages that as a home buyer out there, you might be able to take advantage of. Now, cash buyers, do you have an advantage in waiting? Maybe, but only if supply builds considerably. I don't think that there's a huge advantage in waiting at the moment. But that question that I just talked about kind of goes into this one where Sal's asking how long. No, I'm sorry. Not that one. This one right here. I'll go back to Sal in a minute. SH says, how many days exactly does it need to be listed to get a good price? It depends on the seller and the agent on the other side. If you have 2 people that don't understand what the market is and things are sitting a little bit longer and they're getting anxious, maybe it doesn't take long at all. But that's where to each his own. Each case is a little bit different. But don't expect to go out there getting a good deal, just, or something significantly undervalued. Just know that in this market, things are shifting a little bit. People's emotions are starting to play in to the environment a little bit more on the selling side. And if you're in the right position, maybe there's an opportunity there.
And Jeb, the answer to that is completely dependent on the seller. Probably my
Absolutely.
best example of that. I don't even know if you were in Huntington at this time, but the 2 big houses that were built about 15 years ago on Main Street, 2 awesome lots sitting right next to each other.
Yep.
And the lots were worth about 300 to 325, and the guy listed them for $500,000. And I said, as soon as that guy gets realistic, I'm buying one of those lots. That guy never got realistic. He sat there and sat there and sat there and sat there. And eventually it was like 4 or 5 years later, market took off and he ended up getting $550,000 for the property. So for each of them.
And what's that lot worth today?
Probably 2 million, something like that. So in his instance, the guy had an asset and he was the guy that says, don't lowball me. I know what I got. And he was wrong. It was not worth that, but time proved him to be right. And he didn't have a need to sell. So it really comes down to, does the person have a job in another city they have to get to? Does someone have a closing on their home that they're going to buy that they need to have? Do they have a baby on the way that they need extra room? Some people are motivated. Some people don't care, and they're just going to wait until they get their number.
Absolutely. Sal brings up a really good comment. So, and something I want to put up here. Has there ever been a market that didn't recover? Buy and hold, people. Thanks for all the info. So There's no better way to say that. That's one reason why we say having that longer term time horizon allows you to withstand any potential bumps. Something I've started saying in some of these videos to just kind of, and it's conversations that you and I have had, Josh, is that, over time, annual appreciation averages about what, 5%, right? Over a 30, 40, 50-year period or whatever it is.
60 years. I actually saw
60.
this in a reverse
Okay.
mortgage presentation. They over 60 years, it's like 4.63%.
Okay. So 60 years, it's averaged roughly 5%. So when you have multiple years of 10, 15% gains, which is what we've seen over the last 2 years, maybe 2.5 at the end of this thing or whatever, well above that 5%, in order for it to stick to that trend, which eventually it will probably come down to continuing to average 5%, you're likely to see some pullbacks, right? That doesn't mean crashes, but let's just say hypothetically, it did crash. If it still goes back up to that 5%, there's a reason, there's a trend there. It's because that 5% is on average. So if you have big jump ups or big drops down, eventually it's going to kind of recover in either direction to get you back to that trend. So that's why time, if you have it, is valuable in any market, especially real estate.
Jeb, we've told the story of my friend's parents that bought in 2006, and we literally went through this. Like, this is a very risky time to buy. There's lots of bad loans, homes at an elevated price. And she said, I don't care. I've been a renter my entire life. I'm going to buy a house and I'm going to live here for the rest of my life. And they bought within 6 months of the absolute top, and they didn't care. They took a 30-year fixed. They sat there, they made their payments. They were way underwater. By 2013, they were able to take advantage of the home affordable refinance program and refinance even though they were underwater. And now they've paid that thing down to like $200,000. It's worth over $1 million now. They're going to take their 800 grand. They're going to Tennessee just like everybody else. They're going to pay cash for a big house and call it a day. That's the benefit of taking the long view. That's why Jeb and I say, if you think you're going to buy for a year or two, or you might get moved for a job in a year or two, you might get married in a year or two, or have another couple of kids who may end up being triplets because you're doing in vitro, don't buy.
That sounds like hell, by the way. Just so you.
This comes from a guy who spits out another baby boy every 2.5 years.
Listen, a friend of mine gave me some sound advice back in the day, and I didn't take it. And he said, I said, what is it like going from 2 kids to 3 kids? And he had 2 girls at the time, and I had 2 boys, and he actually had the third. So he ended up having 3 girls. And he said, it's like drowning in the deep end of a swimming pool and somebody throwing you a baby instead of a life preserver. And I was like, at the time I thought, oh, that's funny. And then I had a third kid and I was like, oh, I get it now. I understand exactly what they're talking about. So having 3 at the same time sounds like hell. But anyhow, it's a whole different conversation. Let's see here.
I got a string of comments here that actually they work together, and I kind of like them.
All right.
So Wendell says, "Thank God I'm a veteran, 0 down." He has all of his military patches here to show that. And
awesome.
Then we had a follow up.
Thanks for your service.
Lonnie pipes in and says, "But VA is slow." So wanted to say, based off of that, that's absolutely untrue. We can do a VA loan as fast as we can do any other loan. Nothing goes to the VA. The only thing I need from the Veterans Administration to do a loan for a veteran is a certificate of eligibility. And 90% of the time, we get it in 2 seconds from their website. Sometimes the records can be a little wonky. Something can be off. So we can close a VA loan, and anyone else can close a VA loan as fast as they can close any other type of loan. It doesn't actually go to the Veterans Administration. They don't do any underwriting. They delegate that out to the lenders, and they can go as quickly as any other loan. Now, the next one, Jay piped in and said, USAA loans are the biggest predators, and then says they know you don't shop, so they rip you off. So one of the things that's really interesting, USAA, Navy Fed, and a pure just mortgage bank, Veterans United, they're all large marketing companies. They're sort of like AARP. People think AARP, hey, it's a cool thing that once you're of retirement age, you join and these people do good things for you. They're a giant marketing agency. They want to sell you life insurance, long-term care insurance. They want to sell you all that stuff. USAA, Navy Fed, Veterans United, they all want to sell you mortgages. They want to sell you credit cards. They want to sell you student loans. So they're a giant marketing arm with a big call center. It's no different than going to your local bank and thinking that you're going to get a mortgage expert to give you a mortgage. So it's not that any of them rip you off. You can get a better deal with much better service by going to someone that specializes in those. But big picture, VA loans are great for the veteran. They're actually good for sellers, just in terms of the way the appraisal process works and how we can rebut a low appraisal. So a lot of misconceptions around VA loans. Don't if you're a seller, don't look down on them. Veterans deserve to be able to use their benefits. And if you're a veteran, don't let anyone talk you out of using your veterans benefits.
No, good stuff. So Ariel says, do you think it is still a good idea to be a landlord in California with all the regulations? So, this is one of those things, to each his own, right? Each state has their own issues. California is a very tenant friendly state. California is a very, Josh said it yesterday on a podcast somewhere. We were talking buyer friendly state in that regard too, with regards to the contract. And that's all true. I think it's just more important now to be more detailed on who you decide to pick as a tenant. And that's always the case. But what I've seen over time is people get, lackadaisical, if you will, in how they approach tenants and certain things. And it's whoever will give me the most amount of money or whatever. I think it's more important now to really do your homework on your tenants to make sure they're solid, because people can, not that we're going to have, the stay in place measures again, where people can stay in property and not get evicted and all of that. But the reality is it's costly to evict someone, especially in the state of California. So I don't think it's a bad idea to be a landlord in California. In fact, I would love to invest in California real estate. It's so expensive to do it for it to make sense. Especially from, for an appreciation standpoint. I'd love to own a bunch of California real estate. I don't care about the regulations and all of that. I can deal with it. But it just be detailed in how you approach it. But with that said, there are a lot of opportunities out of state with, other markets and what have you as well. But they're having some of the same issues that California are, with regards to just supply issues and not being able to find anything. So. But if you need a link, again, I popped that on the screen a minute ago. Josh was talking about lenders. You need a good lender. There's a link there. It'll take you to somebody that Josh, and I know, like, and trust, someone to guide you through that process, take good care of you. And a lot of you guys have used it and reached out. So good stuff.
A couple of things in regards to this question to be aware of. Do not ever buy in a rent controlled area. And a lot of them in LA and San Francisco areas are. And just because you buy in an area that's not rent controlled doesn't mean that a rent control bill won't be passed. So know sort of the leanings of the voters in the areas that you're looking at buying, and sort of a story along the lines of what Jeb said. It's a tenant-friendly state, and don't be shocked that tenants in California know the rules and regulations probably better than you do. Had a situation with one of the units in our fourplex over on Long Beach about 6 or 7 years ago. Two buddies, 2-bedroom, they rented, they paid their rent on time every month. Everything's great. They're there about 3 or 4 years. 1 month, the rent doesn't come in. We call up and we go, hey, what the heck's going on? Yeah, my buddy just left in the night. He said, you can't afford it. He's out of here. And I can't afford it on my own, so I can't pay you. So we said, cool. So when can we come get the keys and when will you be out? He goes, oh, no. You have to evict me. It's going to take, 2.5 months. So let me know, file the stuff. And then once everything's done, I'll be out of here. And it cost us a little over $2,000 and 2.5 months of lost rent. And at least he didn't destroy the place, but he knew to the letter what his rights were in that situation. And now from my end, having gone through it, if I knew better, I would say, hey, it's going to cost me about $4,000. Can I give you a $4,000 check to get the hell out of my house?
No, absolutely. I mean, that's why when I sold foreclosures back in the day, with Fannie Mae and Wells Fargo and all these guys, the very first thing we did when we approached one of these properties that was occupied is we offered them cash for keys. And we had an allotment up front that we, if they would get out within, I don't remember the time frame. So, don't quote me on this, but it was like, if you can get out in a week, we'll give you X amount, say $10,000. If you get out in 30 days, it's 5,000. If you get out in 60 days, it's 1,000 or whatever the numbers were. I don't remember because it's been 10 years now, over 10 years since I did that. But that gets attention real quick, especially for people that needed money and were planning on moving or whatever. Either way, it got them out of property. And so, yeah, no, there's definitely incentive to get people to move.
So Jeb, there's a good follow-up on that. Sammy says he highly advises against buying or being a landlord in California. He says own property in landlord-friendly states and live in California. There's some really good reasons for this. This is not in any way bad advice. In a lot of ways, I'm 200% with him. California real estate is a little bit like crack for investors. When you buy right, you get appreciation in California that for the most part you don't get anywhere else. Now, that being said, our little neighboring areas of Phoenix and Vegas have got some really huge pops that match what we have here. They're also a little bit more cyclical and more likely to bust in a bigger level than what we see in areas of California that have more jobs. So you're not likely to get the appreciation in other states over the long haul that you get in California, but you are much less likely to have some of the problems that we talked about here. So from that end, there's definitely some good advice in Sammy's comment.
No, good stuff. And I just threw a logo up in the top right of the corner. And the reason I did that is because, over the originally we started this series, if you will, on live on Wednesdays just to answer questions. And that's why we're still here. But, recently, about a month and a half ago, we started a podcast where we address specific topics in detail on each episode. They're about 30 minutes long, but we kind of do a deep dive into each one of those. Like, what are contingencies, pre-approval versus pre-qualification, or why it's a good idea to buy a house, or should you buy, or whatever the subject is. We do a deep dive into it versus on here, we just answer your questions. So I put that up there because each week now, in addition to that one episode, we throw this live on the podcast in case you want to listen to the entire thing. While you're out doing something, you don't have to be in front of a computer. You can up the speed on Spotify, listen to it at 1.5 speed and
2x.
Yeah. And be done in an hour. But it's up there if you guys want to check it out. So those drop on Fridays. So I upload this to the podcast every Friday. The new episodes post on Tuesdays. So if you want to find us, Apple, Spotify, basically any platform out there that does podcasts, and like it and review it if you like it. So that helps that. So Joe has a question here. Joe was 12 in 2008. But wants to know how the housing market affected the rest of the economy at that time, Josh. So, I'm doing a video.
It crashed the whole thing.
Yeah, it did. But why? I mean, we could talk about tranches and we can talk about all of these different things that really led to it. But essentially what it was a credit crisis. There were so many people invested in mortgage-backed securities, buying in the United States, people's pension funds like Iceland or whatever these states were that had their entire pension fund invested in like these tranches and mortgage-backed securities. And basically, the ratings on the bond companies were rating these tranches, if you will, a lot higher than what they should have been. So they were AAA rated when in fact the majority of the loans in there were garbage. What happened? They defaulted, and the rest is history. And what happened? The credit, that killed credit across the globe, if you will. It affected every market because everybody was invested in U.S. Bonds and mortgage-backed securities or what have you, and just created a ripple effect. And with that being said, banks went the opposite direction, right? Hell, many banks would have actually gone out of business entirely if the government hadn't stepped in and backed them and what have you. But that just created all of these issues. The pendulum swung to the other side. Credit got super tight. Nobody could borrow anything, and the rest is history. Josh, so what did I miss there?
And normally I'm the long-winded one. Jeb just gave the long answer. Here's the short one. Housing downturn has never coincided with a recession other than the 2007-2008 recession, and that was because
The recession
Housing caused
right.
the recession
Right.
for all of the reasons that Jeb just said. And he and I could talk here for the next hour and not do nearly as good a job and not be nearly as entertaining as you going over to Netflix or wherever you can get it, and just watch The Big Short. They do a very good job of explaining exactly what it was. And it's crazy. I was just met with a mentor of mine 2 days ago, and we were sitting there talking about how subprime lenders at that time were coming into our offices and saying, hey, we'll give you better interest rates than Fannie and Freddie will for your good borrowers, the ones that want 30-year fix with the 800 credit score. We're like, why? And if you watch The Big Short, you'll see by taking all of the 500 credit score loans they had, they could put those 800 credit score in there and average them out, and it looks better. So they were overpaying for these really sweet loans to make their crap look better. But your simple question was, well, how does the rest of the economy react? Housing and recessions have never been related other than 07, 08, and it was because housing caused the recession at that point in time.
Good stuff. Jimmy says, what data reports are you guys keeping your eyes on? So
all of them.
Yeah, no, I think, yeah, we're constantly reading, right? I mean, I subscribe to more, news websites than I have the opportunity to read. And same with Josh. I mean, we're looking at signing up for another conference that's like a 5-day conference that's going to have 50 speakers at it that we'll never be able to watch all the information on it. But it's just constantly having, reading data, if you will. But the problem with some of this data is that it is a month old, or, it is weeks old. And that's why, I mean, honestly, I feel, and this is not a pat myself on the back, but I feel like I have an advantage to some extent because I'm actually in the market as an agent. I'm not just somebody up here posting videos talking about data. I'm actually out in the market seeing what's happening around me. And I sell a decent amount of real estate. I network with agents that sell real estate all over the country that are really heavy producers. And we're having conversations. So all of that, looking at the data that comes out, reading, not just real estate data, but just macroeconomic data, what's happening in the macro view of things, taking all of that kind of helps, and Josh reads stuff that I don't read, and I send him articles and he sends me articles, and I talk to people that I feel like, hey, listen, my buddies run a fund in Charlotte, a hedge fund, and saying, hey, listen, what are you seeing? You're in Charlotte. You're in a completely different market than I am. You're in a completely different world with regards to where your investments and your point of focus is. And having conversations with smart people to say, okay, what are you seeing? What am I missing? Let's have these conversations and trying to go deep and go, okay, made good points here, made good points there, whatever. But also you guys ask good questions that cause us to rethink and think things. And I think that's what makes this stuff good.
And it's real time. Like I tell people, like this is an investment every week of 2 hours. Yes, we get to answer the questions, but there's 2 or 3 good questions, really good questions that make you think or think about something from a different angle, or just question the underlying belief. Like again, one of the smartest pieces of advice I can give to anyone is, anytime you think you know something, find someone who thinks the opposite and dig into why they think that. And if you can find reasons, not just your biases of, hey, that person's dumb and they're wrong, but real factual flaws in their logic, well, then you can feel better about your decision. Or you might look at it and go, hey, I thought that person was dumb or crazy or out of their mind, and it turns out they have some really good points. And you kind of build your opinion over time from that, of where it's going to go.
Good stuff. Good stuff. Here we go. Stefan says, what do you think about 40-year mortgages? So Josh, you've talked about how a 40-year mortgage it's not a qualified mortgage. I know we answer this question a lot, but it's something we hear constantly. So kind of give people a really brief overview of why we can't, or we can see them, but why they're not likely.
So any loan with an amortization longer than 30 years falls outside of the qualified mortgage guidelines. In simple terms, it means those are riskier for the lender to make. Lenders price for risk. If they have additional risk, you're going to have a higher interest rate. So for the most part, those 40-year amortization, the benefit of stretching your amortization out an additional 10 years is offset, if not completely offset, at least partially offset by the higher interest rate. So for the most part, unless and until the government changes some of the guidelines that were implemented after the Great Recession and the last housing market downturn. It's just not going to be a good option or an option that helps. And you're probably seeing headlines that HUD approves 40-year loan terms. They did for loan modifications. So for people who are coming out of forbearance, not able to make their payments, they're doing that as a way to keep people in homes, but they're not doing it as a way to put people in homes.
Good stuff. Rob says, I am buying out of state next month. Do you recommend locking in a rate with a builder? If I do and rates decrease, do I get to keep the lower rate? So Josh, let's talk about locking in rates right now. A lot of volatility in the market. We've seen rates go from hell at the beginning of the year, 3.3-ish percent, 3%, somewhere in that ballpark, to 5.5-ish today. What are your thoughts on locking, and what do you do if rates do decrease and you have something locked in?
So on new construction, you're more likely to have an advantageous float down option with a builder and the builder's lender. Not always guaranteed, but it's more likely. So ask them what their float down policy is. Every lender has a float down policy, but what I like to tell people is rates are going to have to move down a lot in a fairly short period of time for you to be able to take advantage of that. The reason being is there is a cost to hedging that loan in the secondary market, which is the technical term of what they have to do to be able to offer to lock in the rate to you. In the real world, there's no rate locks. So they're doing advanced financial transactions called hedging that allows them to guarantee for a period of time your lock. So there's a cost to doing that, and therefore they don't just say, hey, heads you win, tails you also win. There's a cost to doing it. You might have the float down. You want to know what that is. Now, that being said, we said earlier in the show, I think we are nearing the top in interest rates. I wouldn't call this the top, and I wouldn't bet that rates are not going to go higher. So find out what that float down policy is. I would probably lean towards locking. And for those of you that have watched for the last 2 years prior to January of this year, I'm not a fan of locking on new construction because those longer term locks can be more expensive. And for the most part, we've been in a flat to decreasing interest rate environment for the last 40 years. But currently, I think locking is prudent, especially if you're tight on your qualifications and it could cost you the home if something changed.
Good stuff. All right. So an hour in, 355 people watching, which may be the most we've seen on here, Josh. 98 likes. Want to ask a favor. If you're finding any value at all, answered your question, you learn anything, you want to punch me in the face, whatever it is, hit the like button. Again, helps YouTube know that people are interested in it. They share it with more people, helps us accomplish our goal of educating home buyers, creating the educated home buyer, if you will. So hit that and help us out. We would appreciate it. We thank you for being here. And we're going to dive into some more questions here, Josh. So I've started a couple here that we can get into. I really like the star feature. It's kind of nice.
The star feature is awesome. It's making it much easier.
Let's see. So, So Sal asked a question. Do you think the higher rates actually help buyers buy what they can afford? I don't think so, because I think, in my opinion, you've got two different buyers. Or mindsets with buyers typically. You've got the buyers that are budget conscious, right? They have a number in mind that, hey, listen, I'm not willing to go over this number because that is the number that I'm comfortable paying every month. And then you've got the mindset where, hey, I'm going to buy what I'm pre-qualified at. And if that's 800,000 this month, then I'm buying 800,000. If that drops to 750 next month, then I'm buying whatever it is. I think you got the mentality of both people. So I don't think rates go up actually get buyers to buy what they can afford. I think buyers are going to buy what checks the most boxes. And depending on the scenario that they're, if they're one of those buyers that are budget conscious versus max qualifying.
Well, you run the numbers, Jeb, and on average, what everyone's saying, the same buyer buying the same home between
35% increase,
at least 35%. So
yeah, that was the latest Redfin data was 35% increase year over year.
So what's your option? I mean, we're talking about, the question is helping people buy what they can afford? No, it's helping them afford less. If you want to have the same payment as last year, so just for example, say someone can afford $3,000 and last year they bought with a $4,000 payment. Well, the 3,000 gets them 60% less than it did last year. So there's no way that the change in affordability is really helping anyone. If anything, it's forcing people to stretch further, because in a lot of ways, people need what they need. They need to be a certain distance from their job. They need a certain amount of bedrooms for their family. They need certain amenities, be in a certain school district. So yes, there's some substitution effect and you can buy a lesser home, but it's not always that simple.
And I will tell you, coming from a real estate agent's experience, if you will, rarely do buyers go the opposite direction. Rarely do they ever look at $1 million homes, for a consistent period of time, make offers, and then decide they want to buy an $800,000 home or whatever the number is. It doesn't happen. What you often see is people look at $800,000 homes and go, this doesn't check all the boxes, or I don't like this, and look at $1 million homes and then end up in a higher price point. Rarely does it go the other direction. And if people get priced out at a certain price point, I think those people end up sitting on the sidelines. They don't end up settling for much less house. At least that's been my experience. So it'll be interesting to see if, we are having more inventory build at the moment. Prices haven't necessarily been affected where we are, right? Real estate's local. So here in Southern California, prices haven't really gone down, except for on houses that were overpriced to start or what have you. So if inventory does build and homes start to pull back some, then maybe that changes. But at the moment, it hasn't. ET, rad. Any insight into current and future home improvement costs, supply chain issues for materials? So at the moment, I don't know. It depends on where some of these supplies come from. I think you got to look at the moment. I think some of these things are getting worked out. It doesn't look like it because, some of these bottlenecks were so bad. But if you have anything coming from China, Josh and I were talking about this morning, coming from Shanghai or any of these areas that are in complete lockdown. I don't know if Shanghai is in complete lockdown, but one of the areas over there is, which is putting pressure on factory workers over there. People can't go to work. Hell, people can't even leave their house. They're getting food delivered to their door. This is crazy stuff. And this is what happened at the beginning of COVID. But that, again, puts pressure on supplies coming from China. So anything that comes from an area that might have something like that, or something that is coming from Ukraine or Russia or one of these areas, that just creates a bigger issue. I was talking to Josh this morning, I don't know if it was the CEO or somebody from Rivian basically said that he believes that the battery crisis, the electric battery crisis, EV batteries, are going to be a way bigger issue than the supply chain of chips have been on cars, just because of all of these global issues. So I don't know how that translates into building materials, because it's hard to say where a lot of this stuff comes from. So I don't know. I don't know the answer. I just know that there are issues, supply chain issues with completions of houses. Somebody commented in here earlier and talked about trusses, and they were in Florida and said that they were 12 months out on the builder actually getting trusses to complete the houses. That's a problem. So it'll be interesting. I don't think new construction is a piece of the puzzle. It doesn't solve the crisis. It is a piece that helps out with supply, but you can't count on home builders to solve the entire problem. That is why, I'm a big believer that supply is going to be an issue for some time, because it's not as simple as just going out and building more houses at the moment, because of some of those issues we talked about, and regulatory cost and all of that involved.
Something that's a corollary to the supply and demand that we always talk about is that recessions are by definition deflationary. Deflationary in terms of demand going down, both for labor and for goods. Does that mean we go back to what things cost in 2018, 2019? I think that's overly optimistic, but again, only time will tell. I tell anyone that will listen, flipping houses in 2008, 2009 was awesome, because no one wanted the houses that were distressed and beat up. So we could name our price to the bank, and if they didn't like it, we made an offer to another bank. And on top of that, every contract contractor was suffering and hurting and they wanted your business, so they would give you an aggressive bid. And then you could go to Home Depot and Lowe's, and if you would make a $15,000-$20,000 order to redo a house, they're going to knock 25-30% off that bill. I'm sure they're doing something similar for volume purchases right now, but it's not 25-30% off of the total bill.
Right.
Jeb,
No.
you've got to answer a version of this question 87 times. So how about my turn now?
All right, let's hear it.
How does a mortgage broker get paid? So we can talk about brokers specifically, but it's not all that different. So I am a mortgage broker. I'm also the owner of the company. So all of the money that comes in, less all of the expenses, goes to me. But let's say I have a loan officer working for me. We have to set their compensation independent of any of the elements of the loan. So they can't make more for a bigger loan. They can make more in percentage terms, but they can't make more for pushing you to a larger loan. So we can't give them a bigger percentage of the loan if you get a bigger loan. They can't give you a bigger percentage split if you pay a higher interest rate or any of those things. So it has to be the same, and it can't be tied to any of the loan terms. But on the broker side, we can be paid by the lender or we can be paid by you. We cannot be paid by both. So why would a lender pay us? Because we can manufacture a loan and drop it in their lap cheaper than they can do on their own. So there's always the origination side of the loan and then the funding of the loan. So for a major wholesale lender, it is cheaper to originate a loan through the broker channel. So they give us wholesale pricing, better pricing than a lot of the lenders that we deal with. They have a retail arm. So you could get a retail loan. My wife works for a company called Finance of America. We do a lot of business with them. Jeb and I have a friend who works for Finance of America Retail. You can go to him and get a loan through Finance of America, or you can come to me and we might put your loan through Finance of America. I get better pricing than he does because we're doing a lot of the work and covering a lot of the costs that Finance of America does for those retail loan officers. So in simple terms, the lender, we set our compensation. We say on every loan, we want to be paid this percentage of the loan, and they pay us that. And our rate sheet reflects that. Cool. You want 1% of the loan? You want 1.5% of the loan? Here's what the rate looks like for us to pay you that. So it's a little known fact that you can negotiate the terms on that. And if the broker is willing to do it, then it has to be done as a borrower paid transaction. And it gets much more confusing and complex. But that's essentially how it works. But if you're just asking how a loan officer gets paid, again, whoever employs them says, for every loan you do, I'm going to pay you this percentage. Is it 0.5%? Is it 1%? Is it 1.5%? They're going to make that percentage of the loan. And that's where we get to your interest rate is not dictated by what we make. Your interest rate is dictated by what you want to pay. Do you want to pay points? Do you want 0 points? Do you want to get a lender credit? That's where the interest rates change.
Wow. And he said earlier that I took one long. Holy cow. You've got everything you need to know about broker compensation now. Whew. Holy man. Flash a light says, do you suggest sellers declutter their house and maybe do a half move to a storage unit? In some cases, absolutely. Decluttering is always important. A half move to a storage unit may or may not make sense. I think each scenario is a little bit different depending on what your house looks like. But sometimes garages can be used for staging areas. I'm okay with people putting things in a garage. I don't like, just a bunch of stuff thrown into a garage, but it can be used if it's organized correctly as a place to put stuff versus getting a separate storage unit. But the pods that they have out now make moving things a lot easier than, having to actually put your stuff in a truck, drive it to a storage unit, and what have you. Maybe a little bit more expensive, but a lot more convenient for a seller. So an agent will typically walk you through that process. Something I do with clients is we walk through the process when listing it, talk about things that need to be moved around, things we would get rid of. Sometimes we bring in a stager, a interior designer to help us with that as well. But the answer is always declutter. Moving things depends on the situation. So hopefully that is helpful for you. Let's see here. Josh, let's see here. What is Brad and Michelle? Does the interest rate ever get too high that cashing out a 401k and taking the tax hit to avoid a high rate mortgage? So what are your thoughts on because you can cash out your 401k or you can borrow against it. I'm gonna guess that you're against completely cashing it out. But let's hear your answer on this.
Let's do some quick and easy math. Let's say
All
you
right.
have 100,000 in your 401k that you're considering taking out. At current rates, taking $100,000 to put down and borrowing that much less is going to save you about $600 a month. But once we pull that 100,000 out, you have a 10% penalty for early withdrawal. So you just paid $10,000. So you really only have 90,000. So now we're $540 monthly savings. And you're going to pay state and federal taxes on that. If you're making decent money, you just added $100,000 of income on top of that. So you're going to be in a fairly hefty tax bracket. Let's say here in California, federal and state, 40%.
50%.
Probably 50, but at least 40%. So now your 90 is $56,000. So you just paid $44,000 to lower your payment, $320, $330, $340 a month. So when we pencil it out, just quick back of the napkin numbers, there's no world in which that makes sense. Interest rates will be lower again in the future. Save your money for the refinance when rates go down.
All right, there you go. Andres says, do you think investors will come again in the market when prices drop? I don't think investors have really gone anywhere, at least in the markets that I'm in. I mean, you still have pretty heavy investor activity. If you're talking about the big guys, Zillow and those sort of guys, I think Zillow's probably shot at this point. They got shareholders and other people that they have to account to. I don't know that they could go back that direction just because of how they did things initially. But a lot of the pension funds, a lot of these big conglomerates, if you will, are still buying real estate in the right markets. So I don't think that's gone anywhere. But I will say if prices do drop, there's a good opportunity there for, if because rents aren't likely to go anywhere. I think you probably see investor activity stay pretty strong, if not pick up at those times.
What do investors want? They want a return on their money.
Well, cash flow, baby.
Exactly. Well, if they're going to hold, they want cash flow. If they're going to flip, they want an opportunity to buy at a discount, renovate, and resell. So as long as there's opportunity, investors are going to be there in the market. And like Jeb said, investor activity has been heavy from 2010 through today.
Good. Yeah, no, and it's not likely to change in the foreseeable future. Will the rates ever go down again, Josh? Will rates ever go down again?
With 100% certainty, they will go down again. So I think the deeper question is, will they go back to where they were? Will they go significantly lower than where they are today? My answer is yes. The long-term disinflationary factors are still in play that we've had for the last 40 years. We have some weird impacts on the market from COVID, from Ukraine, supply chain issues, all that fun stuff. And of course, our government, made it much worse in attempts to make things better in the early stages of COVID, have made things worse in terms of inflation, home prices, stock asset prices, all that stuff. But yes, so the long-term trajectory is for lower interest rates. Does that mean I think rates are going to be lower in 3 months, 6 months? Who knows? But you go out 24 months, 36 months, 60 months, I do believe rates will be significantly lower than where they are today.
There you go. EWC says, do you recommend doing a 5 or 7 year, basically ARM, instead of a 30-year fixed, and then refi when the rates are down? So good news for you is I'm actually doing a video that posts this Friday where I talk about ARMs specifically and talk about these scenarios, when it's a good idea to consider an ARM versus when you should consider, say, more of a fixed rate, even if the rates are higher. So watch the video on Friday. But no, in reality, Josh, 5-year, 7-year ARMs, rates are a little bit lower than those of a 30-year fixed. Thoughts on considering something of the shorter term at the moment?
So think about this. This is tightly related to the last question. If you believe that rates are going to go back down and go lower in the next 2, 3, 4, 5 years, then this is an excellent strategy if you're getting an appropriate discount. So what is an appropriate discount? A 5-year ARM versus a 30-year fix probably needs to be about 0.75% better. That 7-year or a 10-year about a half a point difference there to make it worthwhile, but you want to pencil it out. And the reality is, Jeb and I had this conversation. Someone had mentioned it to him, and he asked me probably, what was it, Jeb, 2 months ago? And we went and priced it out. I'm like, look at these rate sheets. The 5 and 7s are more expensive than the 30-year. Well, within about 5-6 weeks, we now have a handful of lenders that are real aggressive on the 5 and 7s. Not all of them, still the majority. I had a client who was shopping with 2 different builders, and both of their lenders told them no, the hybrid arms are more expensive than the 30-year fix. So that's still probably the more common answer, but we do have some good sources for those discounted rates. So again, we always say that the numbers never lie. Have your lender pencil it out. What does a 5-1 look like? What does a 7-1 look like? What does a 30-year look like? And for the most part, when you look at a 7 and a 10, they're pretty darn similar. And 10 is about as much insurance as most people need. You're not going to either not sell or refi for the next 10 years. So I'm really comfortable with that product. I'm not uncomfortable with the 7. I caution people on a 5-year just because it sounds like it's a long time frame, but it's actually comes up pretty quick. But even with that, as long as we take the long view, when you see the caps on these adjustables, meaning how much they can go up, if you get a 0.5% discount to a 30-year fix on a 5-1 arm, you're going to come out ahead to about 8.5, 9 years, even under a worst case scenario. But you are going to have 2, 3, 4 years of a higher payment if we hit that worst case scenario. So I'm a little bit conservative, or at least somewhere in the middle. So I like the 7s and the 10s, but it's a great strategy as long as you're agreeing with me that we're going to have lower rates in the near future.
There you go. Darren owns a home in rural Illinois. Bought it a year ago at a very low interest rate. No need to live in it any longer. Doesn't need to sell it either. Sell now or hold for a few years. So I'm a big believer in holding real estate long term if you can afford to do it. I don't know why you would sell it. Especially if you can potentially rent it out and make some cash flow on it. I think long term it's probably a good thing to hold on to it, but to each his own. You got to decide what you're going to do. I mean, if you sell it, you do what? Do what with the money? I mean, you've owned it only a year, so chances are if it's gone up in value, you're going to have some capital gains taxes. The caveat is if you do end up holding it longer than 5 years, then you can't take the capital gains from it. You have to roll it over to avoid those capital gains taxes. So there's pros and cons to each, just a matter of what fits your lifestyle. If you don't need the cash, I don't know that there's any reason to jump at it at the moment. But Josh, anything you want to add on that one?
The question that I always like to lead with again is sell and do what? Do you have, how much money are you gonna net if you walk away? What are you gonna do with that money? Is that alternative investment better than owning this piece of real estate? I like real estate. And again, if you have no interest in being a landlord and that house is just going to sit there and deteriorate or cause maintenance, then maybe the answer is to sell.
Yeah.
But if you can rent it and generate some income, I like holding it, but it really comes down to what are your alternatives for the money you would make if you sold the house.
There you go. Bitcoin Man says, how does your camera look so sharp? So it's all about the lens, my friend. The lens and the camera. So Josh and I both use a Sony A7 III camera. I have a Sony G Master lens on it, which obviously helps with the clarity. So if you need a clear camera, that's what you get.
Jeb was mad because I looked prettier because I had a nicer lens. So he one-upped me and went and got a lens twice as expensive as mine. That's why he always says it comes down to the lens.
Sucker. All right. That's where all your super chat money went to this lens.
It's a $9,000 lens.
So I could look clear on here. Do you guys see commercial space being converted into multifamily residential? Tons of open office space in Irvine these days. Will absolutely never happen in Irvine. Let me tell you, very, very clearly and confidently, you're not going to see that in Irvine. I haven't seen anything like that. In some markets I've seen, where they've talked about converting, old malls and stuff like that into potential residential. But at the moment, not seeing any of it, especially here in Southern California, not likely to see any of it anytime soon. There's a project potentially at Westminster Mall, that I saw that they were trying to potentially get something going in that direction. And quite frankly, that mall's pretty much non-existent outside of the one store that keeps it open there. So, you might see something like that long term, but it would be more, I think, what's the word I'm looking for here? A high rise type, dense type living versus any single family homes or anything like that. Josh, I saw Jay ask a question. I guess he's asked it 4 times. I didn't see it. What's stopping appraisers from simply price gouging their appraisal services? So he's talking about appraisals, getting an appraisal, and talking about how much they charge in order to do it. Like, it's so expensive to get an appraisal that it's almost, price gouging. So Josh, a lack of appraisers, supply and demand.
You guys are going to get tired of the answer always being supply and demand. Demand for appraisals and the supply of appraisers. I was on a call last night with 3 VA experts in a veterans group, and we were talking about this. And one of the loan officers originates in Alaska, and there's a county in the middle of Alaska where there's one appraiser. Guess what his prices look like relative to other people, and guess what his term times look like to other people. And that's not to say that he's gouging. He has a volume of work that he has to get through. They're saying it's about 2 months to get an appraisal back, and it's about $1,500 for the same appraisal that it would cost $550, and you would get in 9 days here in Southern California.
Wow.
So really,
crazy stuff.
Jeb gave you the easy, quick, short answer. Supply and demand. That's exactly what keeps them from price gouging.
No, good stuff. Let's see here. Sue is asking, since you guys are in Cali, what do you see happening in the Inland Empire? I've been seeing price drops, but also seeing some increases. So a little confusion. So I think it's simply that you got some overpriced homes coming down in value. You've got new homes coming on the market that feel, probably testing the water a little bit to see where values are. At the moment, supply is still low in that market. Demand is still relatively high. You got a lot of people, again, being pushed out of areas like Riverside County, or depending on where you are in the Inland Empire, it might be San Bernardino, might be Riverside, might be, who knows what market we're talking about exactly, but people are being pushed out of Orange County, LA County, and heading out there because it's more affordable. So I think demand is still there. But like Josh and I have talked in the past, if the market cools, which I would say it's cooling now, but people take cooling at whatever that means to them. It is still a hot market. It's just not, instead of being 150 degrees, it's 149. I mean, it's still a hot market. But with that being said, if the market continues to cool, or the more it cools, the areas that are affected the most are the areas that are further from the coast, which are those Inland Empire areas. So if you do see a change in prices, those markets are likely to get hit a little bit harder with regards to, to lower prices and what have you.
Jeb, there's several comments here, and I'm a little disappointed because you hit the one right above it, talking about your camera looking so sharp. You wanted to brag on your lens. But
bro,
we got to give Lana credit. She has triplets and she survived. So I don't want to hear any more complaining about your 3 boys, okay? Don't want to hear any more complaining about it.
Lana, you're a saint. All moms are saints, by the way.
Then Anya pops in and says, our VA purchase closed in 19 days from offer to close. So there's absolute evidence that VA loans do not have to be slow. No reason for it at all. And then Kathy Fellows did have a question. Do lenders hate doing construction loans? For the most part, yes. It's a lot more work, a lot longer time frame. So you can make a little bit more money on them, but in terms of just dollars per hour spent and the complexity. That being said, I have a couple of friends that specialize in rehab loans that are not all that different than construction loans, and they love it. So for us, if we get someone that's looking for a construction loan, most likely we're going to refer you to someone that really does enjoy doing it. Because for this guy, not a big fan of the extra work and time and effort, and they're just unique. You should be doing them every day versus 1 or 2 a year if you really want to service the customer well.
There you go. And on the comment about Lana earlier being a mom of 3 or triplets, men, Mother's Day, I don't know, what's it, 3 weeks away? Start planning now. You got a mom, you got a wife, now's the time to do it. Don't be like me and wait till the last minute. Guys, I'm giving you an advance notice here. You got plenty of time, so start thinking about what you're going to do. I actually made a note over here for myself. to do the same thing.
Write it on the back of your hand so you don't forget.
I'm going to write it on my forehead. So you guys have to look at it next week. Bruno, we don't talk about Bruno. No. Yeah, Josh probably doesn't get that. But anyhow, anybody that has kids would. Bought a 3-bedroom, 2-bath October of 2020. In 2021, we expanded our family. We thought about selling and buying a bigger house, but prices are really high in Arizona. Adding a room would increase a lot, our current house. So I'm not sure if you're asking a question, but in this market, adding on, if you can find a reputable builder, a builder that you trust, whatever, adding on can actually solve a lot of those problems and be a lot less expensive to do, assuming it makes sense, right? I mean, but in many places it doesn't, just because of the lot size or what you need to add on in order for it to make sense. So I would say get bids that way, look at what it costs to upgrade and see which one works better for you. I'm not sure if it was a question or not, but that's my answer. Let's see. Select hunts. I work part-time. My wife works full-time. Our new construction home closes May 12th. We signed our disclosure statement as well as locked our rate. Would the lender come back and ask for additional pay stubs? Josh.
So my concern is anytime someone asks this, that there's an issue with providing the updated pay stub. So the guidelines say you have to have a pay stub within 30 days of the note date. So if you're going to close on the 12th, your note is probably going to be prepared somewhere 5th, 6th, 7th, somewhere in there. And we're on the 20th of April. So let's say last Friday you turned over pay stubs for both of you. There's a chance they don't need them. Now, if you gave pay stubs back in the middle of March, they're going to need an updated pay stub. So, and there's nothing ever preventing them from asking for one at the 11th hour. The lender can ask for updated pay stubs right at closing. On top of that, 99% of lenders are going to do a verbal verification of employment at close when they're preparing those loan docs and just say, hey, is Select Hunts still working? Is Mrs. Select Hunts still working? They don't go in full detail like they do in terms of hours and how many years you've been there and all that fun stuff. They mainly just want to make sure you still have a job. So don't quit. We talked about this last week. I had a client get approved for their loan and she quit the next day, which kind of blew up her loan, as you would expect. But it will be documented and verified all the way through the process through closing.
Good stuff. We've got Patrick asking, is it safe to say that subpar credit scores, higher risk loans are realistically looking at 6 to 7% interest rates now, Josh? Have you quoted anything in the 6 to 7% range?
Yes. I have a client right now with a 625 credit score and low down on a high balance purchase, and they are well into the 6s and paying points for it. I haven't seen any lenders offering 7s. And I mean, when I say lenders, FHA, VA, Fannie, Freddie, I don't know if there's an appetite in the secondary markets for rates that high, because their concern is they won't stay on their books very long. So a lender would rather have you take out a 6.25 rate and pay 2 points than do a 7% 0-point loan, because they figure that once you've sunk a couple points, 2% of your loan into cost, you're more likely to keep it a little bit longer. Whereas at 7%, if rates drop back down to 5.5, you're going to refinance out of that and they'll have paid for a loan that doesn't stay on their books very long.
There you go. Nickel 6 deuce. Nickel 6. Oh, look at that. 562. Nickel 6 deuce. I get it. We're here. In the event that a recession happens, is it likely that interest rates will retract? So I actually filmed a video today. It's going to post next Monday where I talk about this specifically, give you charts to go over it. But the easy answer is yes. But I go over it in detail in that video that's going to be on Monday. And we talk about home prices, what happens during home prices during recessions, to give you some more information on that. So check that one out. Listen, I'd like to ask that favor again. 353 people watching, still 164 thumbs up. So if you don't mind hitting this little thing here, it's a thumbs up on the screen to help more people see it. Show us that you appreciate us being here. Again, last year we did 96 hours of live content answering questions. 96, that was 48 episodes that we filmed. This year, we've only missed one since the beginning of the year. So we're on track to do that, maybe even beat it out. Maybe we'll get 100 this year. Holy cow, it seems like a lot. But anyway, if you appreciate us at all, hit the thumbs up. It does keeps us motivated to keep going. Josh, you had posted something in here. Do you offer or you didn't post this, but Rick's636 says, do you offer DSCR loans on first-time homeowners?
So let's first off say what it is: a debt service coverage ratio loan, and it's a loan. So for first-time homeowner, no, because it's a rental program. So if you're looking at living in the property, we can't do that. So what they do is, does the rent that the property will generate exceed the mortgage? And that's the ability to repay that the lender is using to make the loan to you. So I guess for a first-time homeowner, if you're buying a rental as your first home, yes, that should be possible. Some lenders will not make DSCR loans to someone who doesn't own a primary residence. And the reason why is they're thinking that you don't qualify and you're actually going to live in it. So you wanted the DSCR loan to qualify for a home that's never going to be rented.
Gotcha. So sorry, I was reading something there. Josh, I'm going to have you talk about this. Can you talk about taking loans against a 401k for down payment? So a minute ago, we had somebody ask about taking, cashing out a 401k and how that works, the hits, with regards to a 10% plus paying state and federal or what have you. But if you're taking a loan against your 401k, how does a lender look at that?
For the most part, an early withdrawal never makes sense. A loan can absolutely make sense. You can borrow only if you have enough in there, but you can borrow up to $50,000 against your 401k. And in essence, you're going to pay yourself back with interest. So you can get to 100% financing on your property. If you do 3 or 5% down, a small enough purchase, 10% down, you can finance yourself with the money from your 401k that you're going to pay back. On the loan side, we don't even have to count that payment on the 401k loan against you, because if you default on it, it's not like you defaulted on a loan to a credit card or a car. You defaulted on a loan to yourself, and you'll just pay the appropriate penalties. So makes it easy to qualify for the loan. Good way to get access to funds if you can't otherwise do it. And really not a big downside to it. I always like to tell people, let's make that loan as small as possible. Let's use it for down payment, maybe get you a lender credit to cover the closing costs if you qualify with a slightly higher interest rate. But it's a very good way of getting into a property without eating any of the seeds that you've set aside for retirement, because you're going to pay yourself back. And even the repayment terms, they vary. You can get anywhere from about 5 to 15 year repayment. So the longer the repayment term, the lower the monthly payment is on that. And it's just going to come out of your payroll every month. So again, a really good option for getting into a home without having to do a crazy down payment assistance loan at a higher interest rate or any of that fun stuff.
Good stuff. Let's see here. I'm trying to find something.
Here, let me throw this one up, because I think Henry John was actually on YouTube today. Says he heard a lender from Florida today say he expects 6 to 7% interest on a 30-year by summer's end, and close to double digits 30-year around year end. What do you think? I think that's insanity, and he would need to give us some numbers on what's going to cause that. For us to have a 9.5% interest rate, you would need a 7% 10-year treasury. We're currently at 2.84. We have pretty strong support somewhere around 3.25, and even stronger support at 3.65. At some point, the actions of the Fed are going to decrease inflation, and you'll see rates, if not come back down, at least stop going up. So you have to believe that inflation is going to remain incredibly out of control. And if this is the YouTube video we're talking about, his thesis is that the Fed is going to sell all of their mortgage-backed securities because they want to crash the housing market to stop inflation. Just not how it works. Again, we have about $1 trillion less of mortgage bonds available for sale this year versus last year, based off of the number of loans being done. And the Fed is planning to sell in the next 12 months about $1 trillion of mortgage bonds. So the demand is there for those mortgage bonds. So it's not a supply demand issue where that's going to crush the bond market and send rates shooting up to double digits. So highly unlikely to happen. We didn't think rates were going to be at 5.25, 5.5 right now. So could it happen? Could I paint you a picture? Yes. But if so, we're not going to be sitting here on YouTube talking about the housing market. We're all going to be in our bunkers under our homes or shelters, wondering how we're going to survive another week.
I'm going to be surfing. I don't know what you guys are doing. I'm going out in the water.
Charlie, don't surf.
Let's see. Hope says, is there any way to avoid capital gains taxes if I sell my primary residence less than 2 years after buying it? Would taking all the profits, rolling it into another home help avoid it? So
but before you answer, Jeb, is that the number one misconception question that you get asked of people like that?
I think sellers, especially sellers that have owned property long term, right, or owned other properties, because prior to 1997 you could do this sort of thing. Now you can't. So the answer is no. But let's talk about what capital gains are and how you avoid them initially. So capital gains is whenever there's two types of capital gains, but residential capital gains come from selling real estate, and it's the idea that you make profit above the basis of what you paid for that property. So in 1997, I believe it was, they actually changed the laws that says, hey, listen, if you owned a property 2 of the last 5 years as your primary home, you have up to $250,000 that's tax exempt from paying capital gains on. And if you're married jointly, married, you get $500,000 of tax-free gains. Now, if you've owned it less than 2 years and you sell that property, there is a percentage that you have to pay. Now, it's not the same amount, because what happens is the longer you've owned it into that 2-year period, the less capital gains. So that's something to keep in mind. So if you owned it, 1 year and 11 months, it's going to be less capital gains paid than, 10 months of owning that property, because it goes from, short-term capital gains to longer-term capital gains and what have you. But the easy answer to your question is no, without beating this whole thing to death and going into detail about what capital gains are. So you cannot roll all your profits into a new property. That's what it used to be prior to 1997 when they did the tax reenactment or whatever the hell that thing was called, at which point now is the new code. So
Jeb,
again,
do you know what the exceptions are that will allow you to prorate the $250,000 deduction? I know getting relocated for a job is one.
That's the only one I'm aware of. I don't know that there actually is another one.
Okay.
But I know relocation for an occupation is one that you can actually reduce the capital gains on. So, realist guys, if I buy a second home, this is a good question because it never comes up. If I buy a second house as my primary house, so they own a house now, buying another home to become their primary, but end up not selling the first one, what happens to the mortgages and the tax? So, Josh, if I buy my home, say I buy a home now, or I own a home now, I got it as my primary home. My tax basis, is based on that property when I bought it. I go out and buy another property, but decide to keep this one. Does my mortgage change? Do my taxes change now because it's an investment property or because it's no longer my primary?
No. So your risk is you signed an occupancy affidavit with your loan documents. It says within 60 days of closing, you're going to occupy as your residence. Now, you say buy a second house. It wasn't a second home because a second home is different. You're not signing the occupancy affidavit. But if you did, a lender can call the loan due if they could prove that you never occupied it. That would be your worst case. In reality, they don't go and knock on doors. They don't do occupancy checks. I've done this long enough that there were times when you could say to a lender, hey, you don't believe my borrower is actually going to occupy. Why don't you put a condition that we do a 30-day occupancy check? And they would go out and walk through the house and look at the mail and do all that fun stuff to make sure you're actually living in it. But no one does that. So it's highly unlikely that you would ever be found out. But if you were, the lender can call the loan due because you violated the terms of the loan.
I interpreted the question differently. I interpreted the question as, hey, I'm buying a new primary, but I'm going to keep my current home. Does anything happen with the mortgage or the taxes on my current home once I own a new home?
Okay, so
I might be wrong in that interpretation.
No, I think you're right. I was focusing on the first part of the question, but nothing. So when you bought your current home, or the home that you left when you bought that and financed it, you also signed that occupancy affidavit. What it again says is that you intend to occupy it as your primary residence within 60 days of closing. It doesn't say you're going to live there for the rest of your life. So you can feel free to move on from that property without any change to the mortgage. It's not due anything of that sort. It stays there in place. Now, in regards to the taxes, if the only thing that could possibly change that, I know in some states, Jeb, you have different homestead exemptions for your primary residence. I think we
Correct.
have one in California. It's so small that it's not worth talking about, but that could impact your property taxes if you lost your homestead exemption.
Yeah, exactly. I mean, I'm looking at buying some property in Indiana at the moment, and for out of state or for people owning investment property there, it's about 1% higher with property taxes on investment property than it is your primary residence, and that's one of the benefits that residents have owning property there versus investors. So, yeah, you could have some tax consequences, but the mortgage should be fine.
So
Um,
Jeb,
yep.
I don't, this is the mass media, so I don't know if I take this as fact, but an article from the San Francisco Gate says to get a prorated exclusion, says Internal Revenue Service spokesman Jesse Weller, you would have to demonstrate that you were forced to move out of the house for a job-related or health reason.
Oh, health reason. Okay, so there you go. It's
And at that, just Jeb's probably important. We tell them you don't get the whole 250,000 after 6 months or 12 months or 18 months. You prorate it. So you're getting, if you've been there 18 months, you're going to get 75% of that 250,000 exclusion. But for the most part, depending on, unless you have a really expensive home that appreciated a lot, it's probably enough to keep your gains.
No, good. Exactly. So we got a lot of questions in here, guys. Like it's difficult to get through all of these. So I'm apologizing in advance if we don't get to your question, just because it's there's a lot of them coming in. Let's see here. I want to click on some stuff that can help.
Here's more of a comment, but I did want to comment to this comment. 3-putt bogeys. This is Jeb. Is this you?
Yeah,
3-putt
that might be
bogeys?
me. But
Jeb's commenting.
It didn't say 3-putt double bogeys.
Oh, okay, I gotcha. It says I'm going to back out of my new house that I had on contract. My mortgage estimate from February was blown out by the new interest rate, and I still can't lock in at today's rate. Super bummed. $5,000 gone. This isn't uncommon. A lot of buyers, prices are elevated. Even in February, you could have been tight on your qualifications, and you may decide that you can't afford at the higher rate, or the mortgage guidelines may decide that you cannot afford at the higher rate. Either way, we are seeing more cancellations. But with this, depending on the demand and if the seller, it sounds like the property is not even built yet, always ask. Don't just say, hey, you can have my deposit. Explain to them, go in, ask, beg for mercy, see if there's anything. Maybe you can get a portion of that deposit back. Just don't consider your $5,000 gone. Depending on how the contract is written, they may very well have the right to keep your appraisal. It doesn't mean they will. So I would always ask.
Good stuff. Not who, we win, says, is it always a good idea to pay more on the principal? Josh, what are your thoughts on paying down the principal balance of a loan?
Depends on what your alternatives are, and it depends on what your interest rate is. A lot of people here, have 2.75, 2.5, 3.25. If you have borrowed money that cheaply, you likely can get a greater return investing that money elsewhere. So depends on your experience and how comfortable you are with investing elsewhere and exceeding that rate of return. And it's actually an even lower rate of return. If you have a 3% rate on your loan and you're, say, in California, and you're able to deduct that interest, you're really paying somewhere around 2.25% on that money. So it's not a high bar to cross to get a greater return over time. So if you're disciplined in terms of you can take that $100 or $200 or $500 extra principal and invest it every month, either in your 401k or in an IRA or in a non-tax advantaged account, and invest it over the long haul, you should come out ahead and get to a point where that account grows to exceed the remaining balance on your mortgage faster than paying the mortgage down. So again, if you're disciplined and experienced in investing, I would say don't pay it down. If you're someone that if you have a spare $500, you're going to spend it, put it in the house. So a lot of it comes down to a personal decision.
Good stuff. I'm reading through questions here, so I'm kind of out of the loop a little bit on what the hell you even said, Josh. Sorry about that.
It's okay. I'm out of the loop on what the hell I said.
Let's see. I'm looking for good stuff here to help some people.
Hey,
Josh, well, here, I don't know. Did you click on something? I was gonna.
go ahead. No, it's
No,
a good
why
question,
are
Rob.
VA construction loans so rare? Josh, you know anything about VA construction loans? I saw
They
Jennifer Beeston in the comments. Jennifer has
Jennifer.
a really good channel on VA loans. I don't know if she talks about construction or not, but if you're into VA or just in the loans in general, you can check out her
So
channel. A lot of good
if
info there.
Jennifer's still around and she wants to comment, she can feel free to correct me. I don't believe Guaranteed Rate offers VA construction loans, and that's who she works for. Good company, great loan officer. So no knock there. On the wholesale side, we have one lender that does VA construction loans, and there's probably a few others around the country. And the reason is the VA doesn't technically have a construction loan. So what this lender does is they underwrite to the VA guidelines, they manage the construction process, and then they get it insured by the VA post-construction once the house is all done. So again, we talked earlier, do loan officers hate construction loans? Well, construction loans more difficult, longer timeline, you don't necessarily get paid anymore. And in this situation, lenders don't make them because there's more risk in that situation. So and then on top of that, if I wanted to do that, that's a lender that we're approved with. I am not approved to do those VA one-time close construction loans with them because I haven't gone through their 15, 20 hours of education on them because they're more difficult. They want to make sure you actually know what you're doing and you don't take a borrower down the primrose path.
There you go. So she says they do have them now up to 50K. We have somebody who specializes in it. So if you need a VA construction loan, reach out to Jennifer. She can help you with that. Let's see here. Fort Wayne. So that's actually where I'm looking, Rob. I'm looking in Fort Wayne, my friend. It's a crazy market
You
there.
guys are going to be
We're
battling each
competing
other,
against each
competing
other.
bids. I like
We're
that.
competing against each other.
Rob, I'm rooting for you. Mr.
That's
Three Putt
hilarious.
Bogey doesn't need a rental.
That's hilarious. We answered that. So Samson says, thinking of getting my first rental property. What is better, a duplex or a single family home? In the Indiana area? I'm not sure what IND area means. We'll just go with Indiana.
If I remember correctly, I think it was.
We'll go with that. But Josh, what's your thoughts on a duplex versus a single family home as a rental property? Now, remember, rental being they're not going to live in either of them.
Two pieces to it. In general, a $225,000 duplex will yield you more rent than a $225,000 single family. So you obviously want to validate that. The listings that you're looking at, price for price, what is my rent yield for what I'm paying for that property? So that's one good gauge of it. But let's say that one rents for the duplex rents for $250 more in total than the single family. It's not free money. You're now managing two properties. It's one property, but two units. Twice the headaches, twice the likelihood of getting a bad tenant, a tenant beating something up, breaking it, a toilet breaking, a range needing to be replaced, a number of those things. For me, my preference is always units. You're actually spreading your risk. If you have a vacancy, you still are getting half of the rent. But I know some people say, I wouldn't take units if you gave them to me. I only want single families. So look at the rent yields versus the price. Look at the rent yields versus the price, and then just your preference for the extra potential headaches of managing units versus a single family.
All right. So let's see. We're going to just touch on this question here because I think it's worth, we've kind of talked about it at the beginning. So want a more detailed answer, you can go back and watch this from the beginning. But what do you think rates are going to do for the rest of the year? Will there be a pullback once inflation starts to go down? So in theory, yes. As the Fed starts to raise the Fed funds rate, historically speaking, interest rates tend to come back down. At the moment, you have a lot of volatility, right? Rates are going up. I would say abnormally. The jumps are not indicative of what's actually happening in the market, which is, they're pricing in volatility. They're pricing in future adjustments, if you will. I think once Josh and I kind of talked about this, and I'll let Josh finish it up, but I think once you see some stability in that market, and stability meaning the Fed actually does what people are expecting, or in some cases, maybe even gets a little bit more aggressive, which I don't think they'll do, but takes that approach and does what the market wants to see, I think you see the market kind of breathe a sigh of relief and go, okay, they are serious about trying to tame inflation. We can, normalize a little bit. Josh, what are your thoughts on that as we wrap this one up?
The second piece of it, will there be a pullback once inflation starts to go down? Absolutely. The first part, where do we think they're going to be for the rest of the year? It comes back to two things. Do we think inflation will decrease through the remainder of the year? Jeb and I looked at an article this morning in Bloomberg. The guys at B of A seem to think we've seen peak inflation. I have some really, I have some really smart people.
I thought we had it prior to the Ukraine thing. Like I thought.
Yeah.
I mean,
1,000%.
Yeah.
And even at that, I'm not saying they're wrong. I'm just saying I haven't really seen anything that's going to cause it to recede in the short run. I know some really smart people that are looking at all sorts of commodity prices around the world that still can be problematic. And we're really just in the middle of the China lockdowns, where a lot of the supplies for the world come from factories in China that have not been able to operate at full capacity for the last couple of months. So I haven't bought into that. But if inflation subsides at any point this year, rates will come down. If inflation gets worse, rates will continue to go up. The last piece there is, what does the Fed do with mortgage-backed securities? We talked about it earlier. They're talking about 35 billion a week of sales. That's about $1 trillion a year. And with that, it's a little over $1 trillion, I think, if I'm doing the math correctly in my head. But with that, the market should be able to absorb it. And once inflation gets under control and it looks like we're not going to get the soft landing that the Fed hopes for, they will back away from selling mortgage bonds fairly quickly, probably before they get $1 trillion of them off their books, $1 trillion of them off their books. So am I bullish and positive about interest rates going forward? Yes. Am I ready to step in and make any bets on the timeline on that yet? No.
Well, there you go. Enough said. Anyhow, we appreciate you guys being here. We appreciate all the support, the love, the constant badgering we get in the comments from everyone. And I'm being facetious on that. I really do appreciate you guys being here. The comments, the lightheartedness, all the support. It is appreciated. I will say, if you want to hear this in its entirety on a podcast platform, it'll be posted on Friday on The Educated Homebuyer. You can find it anywhere. You can also get better, more detailed information, deep dive into content on there as well that is separate from what I post on YouTube, which I think is good. If you need a referral to a lender, to a real estate agent anywhere in the country, you can click that link in the description below. And lastly, Josh, any parting words before I ask people to hit the thumbs up?
Nothing other than just keep doing the right thing in terms of educating yourself. We talked earlier, there's a lot of misinformation out there. If anyone is spouting opinions without citing data and facts behind it, feel free to discount their opinion. There's a lot of really smart people out there. Some even think Jeb and I are smart, but there's a lot of really smart people out there.
Not my viewers, they don't have that opinion of me.
There's a lot of people putting good information out there. The mass media likes to go with the headlines. If it bleeds, it leads. I would lean away from that. But maybe one of the lead offs to the show in the coming weeks, we can go through a few of the things that we're looking at. But again, even at that, it's self-serving. I sit here and say, you truly do need an expert to walk you through it. We get comments here every week. Well, in my area, I'm seeing price cuts, or lots of homes are going down in my area. And yet you find out where they're at and you look at the data and it's not true. So people have biases and they want to see what they want to see. So they see a price cut or possibly two, and they conclude everything is having a price reduction. When we back out and look at data that we have access to, multiple listing data, the Cromford report out in Arizona, reports on housing here in California, some of the stuff that Bruce Norris puts out, you see that it's not true when you look at the market as a whole. So just, again, consider your sources, check multiple sources, don't take anyone's word for it, and have a long view and make the right decisions for you and your family.
Good stuff. Jennifer Lego, thank you for being here. Thank you for moderating, commenting. You own a house now. You don't really need us anymore, but we still appreciate you being here.
Thank you for not pitching us overboard
and taking the time out of your day to do it. I had something really clever to say, and I forgot what. Actually, I remember it now. It's not clever. It's not profound, but it's a thank you. We had our highest number of viewers on the show tonight, over 400 at one time. So I appreciate that. And I think this is our highest number of likes at 242. So both, thank you for that. We appreciate you. We will be back next Wednesday at our normal time, 5 o'clock, just like